Picture the scene. A government is under significant internal stress, inflation is spiraling out of control, and senior officials are holding frantic, closed-door meetings searching for a way out. Then the saviors arrive. A team of international technocrats touches down, armed with sharp suits, calm demeanors, and a massive checkbook representing emergency liquidity. The headlines the next day scream, "Rescue package secured," and there's this collective sigh of relief in the markets. It feels like a lifeline has finally been thrown to a drowning nation. The markets stabilize momentarily, the handshake photos are taken, and the public is led to believe the worst is over. But then you look closer at the fine print of that rescue, and the narrative takes a deeply contradictory turn. It turns out that lifeline comes with strings attached that are tightening around the nation's economic sovereignty. To unlock the funds, the country essentially has to agree to dismantle aspects of its existing economic structure. The saviors often demand that public spending be slashed, national industries be opened up to foreign bidders, and the currency be devalued until local savings are practically worthless. It creates this jarring contradiction. On paper, they use sterilized, polite terms like structural reform, fiscal responsibility, or market liberalization. But when you look at the reality on the ground, watching the same script play out from the streets of Buenos Aires in the 80s to Seoul in the 90s, it often doesn't look like a recovery plan designed for the patient. It forces you to ask, if the prescribed medicine consistently devastates the domestic economy while ensuring the international creditors get repaid, is it actually designed to fix the economy or just to rewrite it for someone else's benefit? Okay, let's unpack this. The question we're asking today is fundamental. When nations face crisis, are the international rescue packages they receive genuinely a temporary lifeline or a mechanism to fundamentally rewrite their long-term economic sovereignty? Our deep dive today explores this critical contradiction through the lens of Asia-Pacific economies, moving from the harsh austerity of the 1997 crisis to surprising new strategies that link debt relief directly to saving the planet.
And this discussion reveals a profound truth. Traditional crisis management, centered almost exclusively on austerity and fiscal consolidation, has failed to evolve. It just hasn't kept up, even as global debt structures have become vastly more complex and interconnected. We will analyze the specific critiques of past interventions, particularly in Southeast Asia, and then explore innovative financial instruments like debt-for-nature swaps. These offer a way to address the dual and urgent crises of debt distress and climate breakdown simultaneously. This represents a critical pivot, moving from merely managing financial instability to demanding systemic change that supports long-term ecological and economic health.
Okay, so to really get this, we have to start our analysis in 1997. We need to focus intensely on the Asian financial crisis because this is the moment where the global critiques of that traditional IMF model really solidified, particularly regarding its application in major economies like Thailand, South Korea, and Indonesia. What stands out immediately, and what our sources really emphasize, is how fundamentally misapplied the prescription was to the underlying illness.
Yeah, and what's fascinating here is understanding the context the traditional policy playbook was developed in. The IMF standard protocol, the one they brought to Asia, was largely honed through the debt crises of the 1980s in Latin America and Africa. Those crises were fundamentally characterized by large, unsustainable public sector deficits and excessive public external debt held by the governments themselves. So the standard medicine was designed to shrink the state. Fiscal austerity, cutting government spending, massive hikes in interest rates to defend the currency, and a general credit tightening.
But that's the key, isn't it? The sources make it so clear that Thailand, South Korea, and Indonesia were not 1980s Mexico or Brazil. In fact, these were countries the IMF had just recently praised for their remarkable economic performance and sound macroeconomic policies. They were running budget surpluses or maybe small deficits. They did not have big public sector debt issues to start with. So if the government wasn't the problem, what was the underlying illness?
The crisis in Asia stemmed primarily from the private sector. That's the critical distinction. It was a massive financial panic fueled by rapid, often unregulated capital flows. You had domestic companies and the massive Korean chaebols. They'd accumulated huge amounts of high-risk, short-term foreign debt denominated in dollars. And they often did this under the assumption that their fixed or semi-fixed exchange rates would hold forever. So local commercial banks and finance companies were subsequently saddled with enormous ratios of non-performing loans because of all this overextended and, frankly, often speculative credit. The real economies, the manufacturing and trade sectors, were initially sound. But the financial system was a house of cards.
Right. So if the crisis was liquidity driven and rooted in the private financial sector, what was the actual impact of applying the traditional fix of austerity? Critics describe the policy bundle raising interest rates, tightening credit, cutting government spending as a brutal monetary squeeze that was completely counterproductive. Can you detail that squeeze for us?
It was essentially applying a tourniquet to an economy that needed an infusion of confidence. I mean, it was the exact opposite of what was needed. In South Korea, for instance, short-term interest rates were ordered to spike. Sometimes they went over 20%, even 30%, in a desperate attempt to defend the won. Now, that action, while it's textbook for defending a currency against short sellers, immediately strangled the domestic private sector. Those companies that had taken on foreign debt, and remember, this was the source of the problem, found their debt burdens skyrocketing because of the currency depreciation, and they simultaneously faced ruinous borrowing costs locally.
So the outcome must have been just catastrophic for local institutions.
It was. Instead of restoring investor confidence, these policies caused a severe and, an entirely unnecessary economic contraction. High domestic interest rates weakened or just killed off key local private sector institutions, including those powerful cables. This plunged the countries directly into deep recession and massive unemployment. So rather than improving the situation and encouraging stability, the market realized that the cure was making the patient sicker. That led to further sharp downturns in currencies and stock markets in December 1997, even after the rescue packages were announced. The IMF's own later internal reviews implicitly acknowledged that this draconian monetary policy was not suited for a private sector-driven crisis.
And this leads us directly to the core of the political critique and arguably the most explosive allegation, the charge of double standards, where it felt less like a rescue and more like the IMF acting as a, quote, chief debt collector for powerful foreign banks.
This is where the issue of moral hazard comes into sharp focus, and it reveals the systemic inequality inherent in global crisis management. The central charge was that the IMF prioritized creditor repayment over debtor recovery, fundamentally shifting the responsibility for mistakes. On one hand, the IMF demanded stringent adherence to market rules for local institutions. Governments were explicitly prohibited from using public funds to rescue ailing local banks, finance companies, and corporations. If these local entities made risky loans or accrued bad debt, they were forced into bankruptcy according to market principles.
So market discipline applied to the home team. What about the international team?
Well, the double standard applied to foreign banks was staggering. The IMF required the receiving governments, South Korea, Thailand, Indonesia, to formally guarantee or take over private sector foreign debts that had gone sour. This transfer of liability meant that billions of dollars from the rescue package, which were public funds provided by the IMF and other nations, were channeled directly back to international creditors, often large Japanese, European, or U.S. banks. Critics like Jeffrey Sachs accurately labeled this a massive subsidy.
That is such a critical distinction. So the local firms and banks suffered the full market consequences of their risky loans, but the foreign banks were protected from suffering any losses for their risky decision to lend to those Asian firms in the first place. The moral hazard was completely eliminated for the creditors.
Exactly. The governments were forced to socialize the private foreign debt. This ensured the foreign banks got paid in full, sometimes even channeling funds through complex currency repurchase agreements to avoid public scrutiny.
This institutional protection, taken without public debate, caused widespread resentment among citizens and politicians who felt the IMF's allegiance was fundamentally skewed toward protecting the interconnected global financial system rather than stabilizing the Asian economies themselves.
The adherence to market principles seemed to, it just vanished whenever it threatened the solvency of North Atlantic financial institutions.
And the critique gets even deeper when you look at the strategic overreach. Beyond the immediate macroeconomic conditions aimed at short-term stability, the interest rate hikes and fiscal cuts critics observed these extra bonus conditions that mandated far-reaching forced market liberalization.
These conditions went far beyond stabilizing the balance of payments. They fundamentally altered national economic policy. The IMF insisted on the rapid or full opening of specific economies to foreign corporate ownership, particularly in the financial sector. This paved the way for foreign institutions to acquire majority stakes in and take over local banks, finance companies, and large industrial assets at what the sources frequently call bargain prices.
Which raises immediate and really serious questions about economic sovereignty. Was this a financial rescue, or was it a geopolitical maneuver?
For countries like Thailand and South Korea, these structural reform conditions, like permitting foreign banks to own up to 50% or even 100% of local financial institutions, were strategically crucial for powerful nations. Critics argue that nations, particularly the United States and its allies, were leveraging the crisis and the IMF's resources to gain market access. Market access which included control over local industries and the financial services sector that they had previously failed to achieve through normal multilateral trade negotiations, like through the WTO. The financial crisis became a strategic vulnerability that was exploited for long-term commercial advantage. And this solidified the fear that the IMF's role extended beyond objective financial guardianship into geopolitical and commercial maneuvering, acting as a new form of imperial trusteeship.
And the whole process was criticized not just for the policies, but for the execution, the lack of transparency and consultation.
Absolutely. The process was heavily criticized for its secrecy. Policies were usually imposed by a small team of IMF staff, often 7 or fewer economists dealing with a whole complex national economy, after only a few days of assessment. And critically, these policies were dictated, often finalized in private negotiations, without genuine negotiated ownership by the recipient governments or their people. This lack of participation meant that the sweeping policy changes, particularly those that fundamentally altered a nation's long-term economic structure and sovereignty, were viewed as imposed mandates. They weren't seen as collaborative reforms, which made them deeply resented and unlikely to garner the necessary domestic political support for long-term success. The IMF preached transparency for others, but its own operations and policy conditions remained opaque and shielded from independent professional debate.
So that was the failure of the old playbook in the 1990s. We fast forward over 25 years and we have to ask, did the system learn? Because the sources show that the modern debt landscape is even more complex, fractured, and challenging, and yet the austerity trap persists, running parallel to that North Atlantic exceptionalism we saw decades ago.
The current situation is it's structurally more challenging and far less coordinated than the Paris Club era of the 1980s. Globally, external public debt for low and middle income countries, or LMICs, stands at a staggering $9 trillion. But the anatomy of this debt is radically different.
Okay, how exactly has the creditor landscape changed?
The change is twofold. Crucially, private bondholders have dramatically expanded their exposure. They now hold 45.4% of the external public debt of Asia-Pacific LMICs. This is debt held by dispersed, often thousands of individual private investors and funds, which makes negotiations immensely complex. There's no single counterparty or standard framework for restructuring that debt. If you think back to the 90s, much of the debt was still held by a coordinated group of official, traditional creditors like the Paris Club. That coordination mechanism is now largely bypassed.
And the second major shift is the rise of emerging bilateral creditors.
Precisely. Emerging creditors, particularly China, have risen exponentially. For many countries in the Asia-Pacific, China now often surpasses traditional multilateral creditors like the World Bank and the ADB in bilateral lending. For instance, China is the largest single creditor for 7 Asia-Pacific low- and middle-income countries. This includes highly vulnerable states like Cambodia, Laos PDR, the Maldives, Pakistan, and several small island developing states, or SIADs. This shift from club-based lending to a mix of dispersed private bondholders and large, often opaque bilateral emerging creditors makes debt negotiation and coordination efforts nearly impossible under the current common frameworks.
And this complex, fractured debt composition has collided head-on with recent global financial shocks, leading to a severe liquidity crunch in developing economies.
Yes. The period following the Ukraine war and, critically, the U.S. Federal Reserve's aggressive interest rate hikes created a perfect storm for dollar-denominated debt. The upward march of the U.S. dollar appreciation caused sharp currency depreciation in many developing economies. And since debt servicing is predominantly denominated in foreign currency, usually dollars, dollar strength severely escalates debt service costs in local currency terms. Many of these countries are now spending huge portions of their annual budgets just to service foreign debt, diverting funds from crucial public services.
So for many sovereigns, they aren't necessarily insolvent in the long run, but they are facing a severe, immediate liquidity crisis because they can't access fresh capital, right?
That is the core issue for many. For many sovereigns, prohibitively high interest rates and widening bond spreads have locked them out of international capital markets for new financing. Over a fourth of emerging market economies are trading at spreads 9 or more percentage points above U.S. Treasuries. I mean, that kind of risk premium means they are cut off from rolling over existing loans, which is essential to modern debt management. They hit a wall, which is why they turn to the IMF, often as a last resort.
And when they turn to the IMF, what is the gatekeeper policy that persists? The austerity track.
Exactly. Despite decades of accumulating evidence and internal criticism, fiscal consolidation, meaning austerity, remains a stringent condition for receiving an IMF lending program. IMF staff still insist that indebted economies reduce public spending to receive a loan, often requiring cuts equivalent to 3% or more of GDP.
But the sources noted that IMF economists themselves have found that, on average, fiscal consolidation often fails to lower debt to GDP ratios or promote growth. So if the IMF knows it often doesn't work, why is it still the required medicine?
It speaks to institutional inertia and a prevailing ideological belief that debt reduction must come from shrinking the state, even if the math doesn't support the outcome. The economic mechanism of failure is clear. When a country cuts public spending drastically on infrastructure, on social safety nets, on education, it inevitably leads to a sharp decrease in aggregate demand. This contraction slows economic growth, which in turn shrinks the tax base. If the GDP shrinks faster than the debt is paid down, the key metric, the debt to GDP ratio, can actually worsen. Austerity mandates often incur far more damage to economic growth than previously calculated, yet they remain a non-negotiable condition for lending.
And this chronic condition is made infinitely more galling by observing the response to financial turmoil in the developed world, the North Atlantic exception.
The structural inequality built into the system is laid bare by this contrast. We just discussed the severe austerity imposed on LMICs to get a fraction of the funding they need. Now, contrast this with the response to the North Atlantic banking turmoil that began in 2023.
The whatever-it-takes approach for the wealthy.
It's exactly. When Silicon Valley Bank failed, potentially creating systemic risk, the U.S. Federal Reserve rapidly expanded its balance sheet by $300 billion, providing emergency lending, and even uninsured deposits were made whole. At the same time, Swiss authorities intervened to protect interconnected institutions by orchestrating the merger of Credit Suisse with UBS, backed by massive public liquidity guarantees. These were rapid, decisive, and immense bailouts that prioritized protecting interconnected private creditors and financial elites in the North Atlantic.
So the rule appears to be, when wealthy nations face a crisis caused by private institutions, the public funds are used immediately to protect those private creditors from loss. But when vulnerable nations face a crisis, they are forced to dismantle their public services and inflict pain on their citizens before they get help.
That is the structural inequality built into the Bretton Woods system. It's what the 1997 crisis first highlighted, and it persists today. A recent IMF report itself clarified that systemic debt crises are defined as those that threaten the solvency of large and possibly interconnected private creditors. Distressed low-income sovereigns simply don't fall into that category and therefore don't receive that level of protection or urgency. And this reveals a persistent double standard where immediate financial stability for the powerful takes precedence over long-term equitable recovery for the vulnerable.
And making the situation even more critical is the realization of the dual crisis: debt distress and environmental breakdown. These issues are no longer separate. They are amplifying each other.
This is perhaps the most significant structural complication today, particularly for Asia-Pacific LMICs. They are facing overlapping crises of debt distress and severe climate and biodiversity breakdowns, which fundamentally cripple their ability to achieve the Sustainable Development Goals, or SDGs. This creates an impossible existential trade-off: debt repayment versus survival and resilience.
How exactly does climate change directly amplify debt risk, making the financial crisis worse?
Climate events impact macroeconomic stability and debt-carrying capacity dramatically. We call this physical risk, translating into fiscal risk. Take the case of Pakistan's catastrophic floods in 2022, which affected over 33 million people and caused damages exceeding $30 billion. That's over 10% of their GDP. These physical risks lead to immediate infrastructure destruction, massive economic losses, and an increased need for public funds for disaster relief and reconstruction, fundamentally destabilizing their debt outlook and ability to repay.
And simultaneously, the debt burden starves the resources needed to prevent the next crisis.
Precisely. The enormous debt service demands force these nations to reduce environmental protection funding, exactly when they need it most. We see this starkly in Lao PDR, where budget allocation to the Lao Forest Protection Fund fell dramatically from over $700,000 in 2017 to around $170,000 by 2021. Lao PDR has massive, ecologically important forest areas, and their inability to fund protection illustrates this vicious cycle. Debt service demands resources, which cuts funds for resilience, which in turn makes the country far more vulnerable to the next climate shock, drought, flood, or extreme weather, further eroding their debt-carrying capacity. Without massive, sustained, and dedicated investments, which global estimates peg at $4 trillion annually, SEG targets for climate and nature will simply become unattainable.
So if the old medicine is toxic and ineffective, and the patient is now facing these dual reinforcing crises, financial collapse and environmental catastrophe, we need a completely new prescription. The idea of debt reorientation seems to flip the traditional script entirely. It moves from punishment to proactive investment.
That is exactly the goal. The shift is moving past simple debt rescheduling or outright forgiveness, and instead linking debt treatment directly to structural, measurable investments in sustainability and resilience. We need what are called debt reorganization treatments that require contractual commitment to climate-resilient infrastructure and nature-based solutions.
And the innovative instrument that is generating the most excitement in this space, especially in the Asia-Pacific, is the Debt for Nature swap, or DNS. How exactly does a DNS work, and what makes it superior to traditional grants or forgiveness?
A debt for nature swap is a financial treatment where an existing debt obligation, whether it's a bilateral loan or a private bond, is exchanged or forgiven. And it's done in return for a contractual, enforceable commitment by the debtor country to invest the freed funds into nature-positive policies and projects domestically. The core mechanism is a financial conversion. The resources that were supposed to leave the country for debt service are instead recycled locally for environmental purposes. It transforms a liability into a dedicated domestic funding stream.
We have two excellent DNS success stories that illustrate the two main mechanisms: official loan swaps and sovereign bond swaps. Let's start with the official loan DNS, using the Seychelles as an example, since this is the traditional, maybe simpler model.
Okay, the Seychelles case, completed in 2015, involved a trilateral official loan DNS. A third party, the Nature Conservancy, or TNC, using its specialist investing unit NatureVest, provided a new impact loan and grants. This financing package allowed the government of Seychelles to purchase $21.6 million of its debt from traditional European creditors, members of the Paris Club, at a significant discounted rate, often around 93.5 cents on the dollar.
So the government got debt relief by buying back its debt cheaply, and the original creditors were paid out quickly. But the key difference from simple debt forgiveness is the mechanism that ensures the environmental commitment is actually met, right?
Absolutely. The debt service savings are not merely absorbed into the general budget. They were channeled into a new, independent domestic conservation trust fund called SEICAT, the Seychelles Conservation and Climate Adaptation Trust. This trust fund then disperses local currency, funding marine conservation and climate adaptation projects. And critically, the trust manages the flow of funds and ensures that the government adheres to specific nature conservation targets through a rigorous monitoring and evaluation system that was set up with World Bank support. This really demonstrates how a relatively simpler swap structure can convert official loans into long-term funding for specific ecological goals.
That's a great blueprint for bilateral debt. But what about the more complex sovereign bond debt, which, as we noted, holds 45% of Asia-Pacific LMIC debt? The Belize case is frequently cited as a masterpiece of financial engineering, proving that DNS can work for dispersed private bondholders too.
Belize's sovereign bond DNS in 2021 was truly monumental. It was, because it successfully addressed widely held sovereign bonds, which are notoriously difficult to restructure. It was the largest single DNS ever executed globally. Again, TNC acted as the third-party intermediary, repurchasing Belize's existing sovereign bonds at a discount from the private bondholders.
But TNC is a conservation organization, not a massive lender. So how do they manage to fund such a large buyback and provide favorable terms?
This is where the financial engineering comes in, and it's critical for you to understand this mechanism. TNC, through a specialized fund, issued new financial instruments called blue bonds. These blue bonds benefited from crucial credit guarantees provided by development finance institutions, or DFIs, specifically the U.S. International Development Finance Corporation, the DFC. That DFC guarantee effectively insured the new bonds against default, making them extremely low risk.
So the credit guarantee significantly reduced the risk profile for investors. And that means investors accepted a much lower interest rate on the new blue bonds than they would normally demand from a high-risk sovereign like Belize.
Precisely. The credit enhancement reduced the interest rate burden on Belize from around 8.5% down to an extremely favorable rate, generating massive cash savings over the life of the loan. In return for this favorable refinancing, Belize contractually committed to legally protect 30% of its ocean area encompassing crucial barrier islands, coral reefs, and mangrove forests. They also established a large endowment fund to finance conservation after 2040. The success was so significant that it resulted in an improved sovereign credit rating for Belize. And that's critical, as it turns a potential downgrade, which often follows debt restructuring, into a powerful positive signal to the global market.
That improved credit rating is an immense incentive. To make any DNS successful, though, what are the indispensable requirements that ensure these aren't just one-off deals?
For any DNS mechanism, official or private bond-based, to be scalable and successful, 4 conditions must be met rigorously. First, strong political will from the debtor country is non-negotiable, coupled with a clear, nature-positive national plan. Second, clarity on the types of debt being swapped is essential. Third, and this is most critical for pricing, there must be international credit guarantees from DFIs, MDBs, or private insurers to provide the necessary credit enhancement and favorable terms for the new financing.
And the fourth.
Fourth, and this addresses the accountability concerns of past programs, robust monitoring, reporting, and verification. MRV systems must be in place. An MRV system is essentially a set of independent auditors and scientific tracking metrics designed to ensure that the conservation commitments are not just empty promises. If the recipient country, say Belize, fails to meet its contractual commitment to protect that 30% of its ocean, the MRV system triggers penalties. Things like requiring extra payments into an escrow account or accelerating repayment of the new debt. This mechanism ensures true accountability beyond simple government pledges.
Now, beyond swaps, the market is developing entirely new instruments aimed at linking finance directly to environmental performance without the complexity of a full debt restructuring. Let's look at 2 critical types of sustainable finance: sustainability-linked bonds and thematic bonds.
Right, so first we have sustainability-linked bonds, or SLBs. These are fixed income instruments where the interest rate adjusts or the coupon rate changes based on whether the sovereign meets or fails to meet predefined key performance indicators, or KPIs, related to sustainability. For instance, a KPI might be reducing carbon emissions by a certain percentage by a specific year, or increasing the area of marine protected zones.
And what's the major advantage of an SLB over a traditional green bond?
The flexibility of the proceeds. With traditional thematic bonds, the funds raised are restricted to specific predefined green projects. With an SLB, the proceeds are unrestricted, giving the government flexibility in how they allocate funds across the budget. The financial incentive measures the outcome, the KPI results, rather than restricting the use of the capital raised. It's an incentive-based structure designed to drive countrywide policy change.
Then we have thematic bonds, which include sovereign green, social, and SDG bonds. I know Indonesia launched the first sovereign SDG bond in Southeast Asia in 2021.
They did. And these are targeted specifically at the rapidly growing pool of private investors who prioritize environmental, social, and governance criteria, or ESG. This market is massive. Green bond issuance alone recently hit a $2 trillion milestone globally. In the Asia-Pacific, regional initiatives are crucial for standardizing these markets. The ASEAN Capital Markets Forum has been actively developing the Asian Green Bond Standards, Social Bond Standards, and Sustainability Bond Standards, alongside regional taxonomies. This standardization effort is essential for harmonizing investment rules and scaling up cross-border investment in sustainable finance across the region.
Okay, let's apply this new thinking to the Asia-Pacific case studies, starting with Lao PDR. They have a massive debt problem, and much of it is tied to one emerging creditor.
PDR is highly debt vulnerable, with its total external debt stock reaching nearly 100% of gross national income, compounded by a severe foreign currency shortage. The crucial challenge is its creditor composition. Over half of its public external debt is owed to emerging creditors, with 50.9% owed to China alone. Projected debt service in 2023 showed China receiving half of the country's entire external debt payments.
So that unique creditor composition, that heavy reliance on China for both infrastructure financing and debt holding is the challenge. What's the DNS potential there, given the lack of Chinese precedent for swaps?
The potential lies in converting part of China's official concessional loans, like the loan contracted from Checksum for the high-profile Laos-China Railway project, into dedicated local currency funds for forest protection projects. Lao PDR has already prepared sustainable development plans that include specific, ready-to-implement forest protection initiatives, making them prime candidates for this kind of swap.
And if they convert the loan into local currency funding for nature, what financial risks does that mitigate for Lao PDR?
It potentially mitigates currency risk, which is currently strangling the country. If Lao PDR can negotiate an agreement where the interest portion of the debt service, or even a small portion of the principal, is paid in local currency into a local, independently managed nature conservation trust fund, that eliminates the foreign exchange risk on that portion of the debt obligation. Now, this requires China to adapt its lending regulations, moving past simple cash repayment toward accepting in-kind or local currency payments tied to environmental benefits.
Okay, moving to Pakistan, a country facing high debt risk compounded by extreme climate vulnerability.
Pakistan presents a case where debt treatment must be intrinsically linked to climate resilience. The 2022 catastrophic floods are a constant reminder of the physical risks they face. And crucially, Pakistan has a history of successful debt for development swaps, including earlier initiatives with Canada, Germany, and Italy targeting education, health, and infrastructure spending. So this means the precedent for SDG-aligned debt treatment exists domestically.
So the strategy isn't about pioneering a new structure, but scaling up an existing one and reorienting it toward climate.
Exactly. The current strategy involves reorienting debt service savings into specific climate programs and biodiversity initiatives. Given the scale of their borrowing needs and environmental challenges, linking debt treatment to specific large-scale environmental outcomes, such as replenishing the operational budget of the Forest Protection Fund or funding programs like the 10 billion tree tsunami, could provide the necessary dedicated ring-fenced financing that austerity measures currently starve the country of.
And finally, what about the small island developing states, the SIDs in the Asia-Pacific, like the Maldives, Samoa, and Vanuatu? They are arguably the most vulnerable to the intertwined crises of climate and debt.
SIDs face high debt-to-GDP ratios and are extremely susceptible to existential climate impacts, ranging from sea level rise to devastating cyclones. For them, DNS instruments are viewed as particularly strategic and potentially superior to reliance on external grants. Experts argue that DNS arrangements could be structured to make the climate commitment senior to debt service. In this model, the environmental commitment becomes a primary obligation that secures the financial arrangement itself, mitigating both debt distress and environmental risk simultaneously. This provides a more robust, self-sustaining, and long-term financing model than depending on often scarce and inconsistent grant funding.
So we've established that innovative, nature-aligned financial instruments are available, and they are critical for the Asia-Pacific's future resilience. But getting them implemented requires overcoming immense structural hurdles, especially regarding coordination with the emerging creditor giant China.
Navigating debt reorganization with China is extraordinarily complex because their lending governance is distinct, fragmented, and varied. Unlike dealing with a Paris Club member or private bondholders, debtor countries must understand China's internal lending architecture, which involves multiple government entities and different categories of loans, each with unique rules for repayment and restructuring.
Let's break down that complexity. What are the 4 types of Chinese overseas loans that a sovereign debtor needs to be aware of, and how do they differ in terms of reorganization potential?
They fall along a spectrum of public liability and concessionality. First, you have zero-interest loans. These are fully concessional, essentially counting as official foreign aid from the Ministry of Commerce or CIGCA. These are the easiest to forgive, and China has precedent for unilateral cancellation, mainly in Africa so far, but they're relatively small in scale. Second, low-interest concessional loans. These are subsidized by the Ministry of Finance and often provided by the Export-Import Bank of China, Checksum. They carry favorable rates, usually around 2 to 3% interest, and are large in volume, often financing major infrastructure. Third is the Preferential Export Buyer's Credit, or Heavy C. Also 2 to 3% interest, they involve government ministries and are quasi-official, linked to buying specific Chinese goods or services. And finally, you have market-rate commercial loans. These are provided by massive state-owned financial institutions, SOFIs, like the China Development Bank or ICBC. These are purely commercial in nature, often at high interest rates, LIBOR plus 1 to 4%, and are usually the highest volume component of the debt pile.
So the fundamental policy challenge for implementing a DNS is that China has no precedent or formal internal framework for converting these commercial or even concessional loans, aside from simple forgiveness of the zero-interest loans, into a nature-aligned instrument. Why is that?
That's the core hurdle: institutional rigidity and internal incentives. While zero-interest loans are easy to forgive due to minimal internal coordination needs, they are small in scale. The large commercial loans held by the SOSCDB, ICBC, are fundamentally commercial enterprises. These SOFIs prioritize preserving assets, maximizing returns, and increasing revenue. They lack the political willingness or internal mechanism to bear losses or forgive principal for environmental outcomes without a top-down, powerful policy shift from Beijing. Even for the concessional loans, the government entities involved do not have direct power over the disposal of the loan principal. It requires complex changes in banking and regulatory frameworks to allow for debt-for-nature conversion.
So if the commercial arms are resistant, how can debtor countries like Laos PDR or Pakistan successfully leverage engagement with Beijing? They can't just expect China to act like a traditional Paris Club member.
They must appeal to China's stated commitments and strategic goals. China has strongly expressed a commitment to supporting international development, biodiversity, and global environmental agendas, particularly through its Belt and Road Initiative's green focus. So debtor countries can proactively request that all or part of a loan obligation be reoriented toward a nature-positive outcome that aligns with China's domestic priorities.
Is there a specific leverage point they could use?
One intriguing potential leverage point is linking debt reduction to the retirement of high-polluting assets like coal plants that are often owned or financed by Chinese-backed SOEs in the debtor country. Converting the SOE loan into a debt for climate swap could simultaneously accelerate a green transition and provide debt relief. It offers a mutual win that aligns with Beijing's international narrative while also addressing the commercial nature of the debt.
The coordination complexity required is huge, involving multiple Chinese ministries and banks, sometimes all for a single deal. This just underscores the urgent need for institutional reform in the traditional financial governance structures, namely the IMF and the multilateral development banks, or MDBs.
Structural governance inadequacy remains the primary impediment to scalable, equitable solutions. The IMF's quota system is fundamentally skewed. It determines member states' voting shares, their access to lending, and their allocation of special drawing rights, SDRs. And crucially, the United States holds 16.5% of the voting shares, which grants it veto power over major reforms and any changes to the Articles of Agreement, which require an 85% majority. This system inherently hinders necessary structural rebalancing and gives disproportionate control to wealthy nations.
And that inegalitarian quota system severely impacted the distribution of emergency liquidity during the pandemic, specifically the massive special drawing rights allocation. What are SDRs, and why did the 2021 allocation fail LMICs?
SDRs are a technical instrument. They're not a currency, but a potential claim on the currencies of IMF members. They're essentially international reserve assets that can be exchanged for hard currency. The 2021 SDR allocation, the largest ever at $650 billion, was grossly ineffective for LMICs because allocation is strictly quota-based, meaning the more quota you have, the more SDRs you get.
So all that emergency money went to the countries that didn't really need it.
Pretty much.
Yeah.
Nearly 2/3 of that $650 billion allocation went to developed countries, with over $100 billion going to the U.S. alone, while low-income countries received only about 1%. This is a monumental missed opportunity to inject crucial, no-conditionality liquidity where it was needed most to stabilize economies battered by the pandemic and climate shocks.
So the structural flaw in the governance system meant that the world's largest emergency liquidity injection largely bypassed the countries that needed it most for debt stability and climate adaptation. What reforms are being advocated for the SDR system beyond decoupling allocation from the quota system?
Since decoupling is politically unlikely, the immediate focus is on rechanneling unused SDRs. Rich countries have held on to the bulk of their allocation, estimated at over $150 billion held by the U.S. and $200 billion by Europe as reserves. These unused reserves must be rechanneled into concessional financing facilities operated by the IMF, specifically the Resilience and Sustainability Trust, or RST, or the Poverty Reduction and Growth Trust, the PRGT. These IMF facilities provide longer-term, affordable financing for climate adaptation and balance of payments needs. While they currently lack the massive capacity required, rechanneling unused SDRs is the fastest way to scale them up immediately.
And finally, to meet that estimated $4 trillion annual investment gap for global environmental sustainability, the role of multilateral development banks must be scaled up drastically. What needs to change in their operations?
MDBs most drastically increase their lending capacity by revising their capital frameworks. Currently, MDBs operate under highly conservative capital adequacy requirements, meaning they hold vast reserves relative to the risks they take. If they revise these frameworks, For example, by maximizing leverage based on their AAA credit ratings, they could free up hundreds of billions of dollars without needing new capital injections.
So they need to be less risk-averse.
Exactly. And furthermore, they must increase their capital base, though efforts like the World Bank's recent commitment to boost lending by only $5 billion annually fall far short of what is required. MDBs need to take on greater risk and, critically, provide crucial credit enhancements and guarantees, like the DFC did in the Belize DNS, to mobilize private capital on the scale needed to address climate and debt distress simultaneously. They need to transform their role from cautious lenders to powerful financial facilitators.
Here's where it gets really interesting. We've seen that the global financial system is trying to pivot from simply cleaning up financial messes with ineffective austerity to actively structuring financial health that supports environmental health. The debt for nature swap model flips the script from austerity first to planet first, giving struggling nations a genuine mechanism to turn their financial debt into long-term ecological wealth, provided we can fix the governance roadblocks.
And the conversation is moving decisively toward a recognition that the crises of debt and nature are inseparable and mutually reinforcing, particularly in the Asia-Pacific. If we connect this to the bigger picture, the urgency of reforming institutions like the IMF and successfully engaging new creditors like China isn't just about fairness or economic stability, it's about mobilizing the trillions necessary to safeguard the global ecosystem upon which all future economies depend.
The greatest long-term financial risk for any nation in the 21st century is not high interest rates or inflation, but the permanent, unmitigated depletion of its natural capital.